You know, trading isn't just about crunching numbers or setting up some magical formula of rules to follow. It's not always about creating algorithms, rigorous testing, or taking care of your trading bot army. It's really about you. Even when you're using algorithms, your emotions, biases, and personal risk tolerance sneak in and influence your decisions. And honestly, understanding this is half of the battle. Managing risks isn't just about math, it's also about psychology. And in this video, that is completely different from what you are used of me, I want to dive deep into our minds that can either make or break our trading performance. So let's start with risk tolerance. Every trader has a unique level of risk that they're comfortable with. And this isn't just about money, it's also on how you react when things go sideways. For example, during a drawdown, fear can creep in and you might start to doubt your strategy or feel tempted to shut things down entirely. But also, on the flip side, when you are winning, overconfidence can lead you to crank up the risks unnecessarily because you think you have found the holy grail of trading strategies. And sticking to your strategy during these highs and lows isn't only tough, it is crucial. Self-awareness is the secret weapon here. Recognize when you are acting out of fear or greed and remind yourself of the long-term goals. Losses will come, but they won't define you. Your resilience does. Now let's first talk about two emotional heavyweights, overconfidence and fear. Overconfidence makes you think you're invincible, like your strategy will outperform no matter what. And this mindset can lead you to ignoring warning signs or taking more risks than your system can handle. And then there is fear, which is like overconfidence's shadow. This can make you overly cautious, and maybe you shrink your positions too much to avoid trades, even when all the signals are saying go for it. Now, how do you fight these? Personally, and from what I've learned in the field, I say always that rules keep you sane. Those cold and hard, unbendable rules. You should write them down and stick to them. And always check yourself and these rules when you feel either overconfidence or fear creeping in. But the main culprits that I want to discuss here in this video are biases, because these are your mental saboteurs that you are probably unaware of. And these biases are so sneaky, you don't even realize that they're there. But they shape your decisions. Now let me cover some very important ones that you might experience in your trading career next. So let's talk about confirmation bias first. It is something that we all fall into at some point, especially in trading. Essentially, it's when you only pay attention to information that confirms what you already believe in and ignore everything else, even when that everything else is super important. It's like if you're convinced a coin is going to shoot up because of some new tech or product, so you keep reading glowing articles about it. But you completely gloss over reports about the developers mounting debt or lawsuits. You're cherry-picking the data that makes you feel good about your decision, which can lead you to a very risky path. Now, why does this happen? Honestly, it's just how our brains are wired. We love being right, it's comfortable, and when money is involved, that comfort becomes even more seductive, because nobody wants to face the possibility that their grand investment idea might flop. So instead of questioning their stance, traders double down on it, finding more reasons to feel justified. It's a classic mental shortcut, but in trading it can be very costly. Recognizing confirmation bias can be tricky, but it's all about asking yourself some tough questions. For example, are you avoiding evidence that challenges your trading idea? Maybe you're skipping over analysis that point to a downturn, or only running backtests during the most favorable time periods. And if you're doing that, then it's a red flag. You've got to force yourself to step outside of that comfort zone and actively look for counter-arguments. It's like playing devil's advocate with yourself. If you're bullish on a trade, dig into reasons why it might fail. Now here's a concrete way to deal with it. Keep a journal, and don't mean just jotting down numbers, I mean writing out the why behind your trades. Document what data supports your position and, more importantly, what data contradicts it. Then you can review it later with fresh eyes. And this practice keeps you honest and makes you less likely to get blinded by your own bias. Let me also give you an example to make things clearer. Imagine that you're balls deep into a meme coin because it has such an appealing community. And you've also done some research, or so you think. All your sources consist of bullish blogs and investor sentiment. And in the meantime, you ignore the warnings from people on Twitter or X or on Reddit that say that this is a scam coin. And you enter the trade with full confidence, only to watch the price plummet after that because the developers decided to do a rug pull just after you entered. Now that's confirmation bias in action. If you'd taken the time to explore opposing viewpoints, you might have avoided the loss, or at least sized your position more cautiously. Now let's move on to survivorship bias, which is sneaky in its own way. It's what happens when you only look at the winners and forget about all the failures that came before them. In trading, this is usually showing up when you are analyzing strategies or coins that focus solely on successes, ignoring the losers. And let's say that you are testing a strategy using a list of crypto pairs that are still actively traded today. Now you might conclude that your strategy works great, but you ignore all the crypto that failed, got delisted or was hacked. And this will skew your perspective because it makes things look better than they really are. This is also why I use a list of pairs in my tests that are several years old. But where does this bias come from? Well, it's kind of a natural bias, honestly. The winners are visible and then the losers tend to fade away. Nobody talks about crypto that trended 5 years ago or those that just faded away. Our brains just like to work with what is easy to access. And that usually means focusing on survivors. But in trading, that creates a false sense of security. Recognizing survivorship bias means being really critical about the data you're using. And you should ask yourself, am I only testing crypto that is still standing? If the answer is yes, then you've got a problem. And the best way to counter this is to deliberately include the failures in your analysis. For example, when you're backtesting a strategy, make sure your dataset includes delisted or older cryptocurrencies that didn't make it today. And I admit that it's not always easy to find this data, but it's worth the effort. Without it, you're just fooling yourself into thinking your strategy is more reliable than it is. Look-ahead bias is one of those subtle traps that sneaks into your trading analysis without you even realizing it. And essentially, it happens when you unknowingly use future information. That is data that wouldn't have been available at the time of the trading decision. This makes your backtests look way better than they actually perform in the real world. And it's like cheating on a test and then thinking you're a genius because you aced it. Now, this bias usually creeps in when you're building or testing a trading algorithm. For example, imagine that you're backtesting a strategy and the system uses the closing price of a pair to decide whether to enter a trade the next day. But there's a catch, because the closing price for a given day wouldn't have been available when making that decision. So in real-life trading, you'd never had access to the data your backtest relied on. And this creates unrealistic expectations on how your strategy will perform. Spotting look-ahead bias can be tricky because it's baked into the design of your backtesting process. One telltale sign is when your backtests show unrealistically consistent or high returns. And if the end results seem too good to be true, then it probably is. Another way to identify look-ahead bias is by closely reviewing your backtesting logic. And here you should try to find out if you accidentally use future prices or outcomes in your decision making. And if so, then that's a red flag. Now the good news is that you can prevent look-ahead bias with a little bit of extra effort. First, you have to ensure that your backtesting framework is strict about only using data that would have been available at the time of each trading decision. And this means that you carefully have to align your timestamps and ensure that no future data sneaks into the calculations. Secondly, you can validate your strategy with out-of-sample testing. And this basically is testing it on a completely different dataset to see if it holds up. And if it doesn't, then chances are that your original backtest was flawed. Now, overfitting bias. This bias, also known as curve fitting bias, is also a major pitfall for traders who love to tinker with their strategies. It happens when you create a model that's so perfectly tailored to historical data that it captures every little detail and noise from the past. But the problem is here that this model becomes useless when facing new data. It's like training a dog to sit down only when you're wearing a blue shirt. And that's fine for a specific condition, but terrible for anything else. This bias often arises when you're backtesting and you keep tweaking your parameters to maximize performance. And you add more rules, adjust settings, hyper-optimize multiple times, and before you know it, your strategy looks like a masterpiece, but only in hindsight. And the trouble is here that markets don't repeat themselves exactly. Overfitting creates a strategy that is overly rigid and unable to adapt to new conditions. Now you can recognize overfitting when your strategy performs exceptionally well in backtest, but flops in live trading or out of sample testing. And if you see that your model has too many parameters or relies on overly specific conditions, then that's another clue that you might gone overboard. To avoid overfitting, you have to keep things simple. I always say that the fewer parameters your strategy has, the better. I think that you should focus on the core principles that drive the market, rather than trying to capture every little fluctuation. And also always test your strategy on out-of-sample data and do extensive forward tests to see if it can perform in different conditions. You have to remember that it's okay if your backtest results aren't perfect, because a robust adaptable strategy will always beat a fragile one. I learned this the hard way when I was trying to optimize a trend following system. I kept adding more and more indicators and rules to make it perfect. And in my backtests it started to show incredible results. But when I ran the strategy live, it completely tanked and my account was blown. And you know why? Because the real market didn't match the overly specific scenarios I tailored the system to. It was a tough lesson, but it taught me to prioritize simplicity and robustness over perfection. The next bias I want to mention is the anchoring bias. Now, anchoring bias is one of those mental traps where you get fixated on an initial piece of information and let it overly influence your decisions. In trading, this might look like focusing too heavily on the price at which you bought a coin, or on an early piece of analysis, even when new information suggests that you should think about things differently now. And this bias often kicks in because our brains like to latch onto a starting point to make sense of things. It is somewhat of a cognitive shortcut, but can hold you back in the fast-moving world of trading. For instance, if you bought Bitcoin at $100 and it's now trading at 80, you might stubbornly hold on to it, thinking that you'll sell it when it gets back to 100 again. But the market doesn't care about your anchor, it moves on, and so should you. Recognizing anchoring bias starts with noticing that you're stuck on a particular number or idea. A good indicator of this is when you refuse to sell a losing trade because you were waiting to get back to even again. And you can also see that when market tops or important price peaks are reached again, and they cannot break through this ceiling. Somebody bought it at the top and was waiting all the time to finally sell the coin at break even again. But it can also be that you are ignoring a new idea because it contradicts with your original analysis. And these are signs that you might be anchored. The best way to combat this bias is to focus on the present. For example, you can ask yourself the following question, like if you didn't already own this stock or coin, would you buy it at today's price? And if the answer is no, then it's probably time to rethink your position. Also, make it a habit to reassess your strategies regularly and consider new information objectively, without clinging to outdated ideas. Recency bias is when you give more weight to recent events while ignoring the bigger picture. It's like saying, the market just had a fantastic month, so it's bound to keep going up. Or, the last 3 trades were losers, this strategy might be broken. And it's all about letting short-term patterns cloud your judgment, even when long-term trends tell a different story. This bias stems from how our brains process information. Recent events are fresh in our minds, so they feel more relevant or important than older data. And this is a result of our survival mechanism. Our ancestors needed to react to immediate threats, not to events from a week ago. But in trading, this instinct can cause us to overreact to the latest market moves, instead of sticking to a well thought out plan. The tricky part here is to recognize when you're falling for it. If you find yourself basing decisions on what just happened rather than on a solid analysis of historical data, then that's a red flag. I'll give you an example. Imagine that you have 3 losing trades in a row and you decide to scrap your strategy entirely. That's recency bias talking. Or maybe the market has been on a hot streak and you start ignoring risk controls because you think the good times will never end. This is also a form of recency bias. And to combat this, you have to zoom out. You have to look at the bigger picture. Historical data, broader trends and multiple time frames can help you see beyond the latest blips. And it can also help if you keep a journal of your trades. Document why you made each decision and compare short-term results to long-term performance. This can give you perspective and remind you to not overreact on a few recent events. Now, hindsight bias is that I knew it all along feeling that you have after something happened. In trading, it's when you look at past events and convince yourself it was obvious. And you can recognize this if you say to yourself, of course the market crashed, how could anyone not see it coming? Or, obviously that meme coin was going to rally after Trump tweeted about it. Now, the problem with hindsight bias is that it makes you overconfident in your ability to predict the future, even when your past decisions weren't as clear-cut as you remember them. And this bias happens because our brains love to create a neat narrative. Once we know the outcome, our minds retroactively connect the dots to make it seem inevitable. It's comforting but misleading, especially in the chaotic and unpredictable world of trading. Again, you can spot hindsight bias when you find yourself saying things like, I knew this would happen, after the fact, even though you didn't act on that supposed knowledge. Or when you analyze your past trades and rewrite the story in your mind to make it seem like you made decisions with perfect clarity. And to avoid hindsight bias, you should focus on documenting your thoughts process in real time. Write down why you're making each trade, what you expect to happen, and what could go wrong. Or why you created these sets of rules for your trading strategy or algorithm. What was your thinking process behind this logic? And then, when you review your performance after a while and pick up your journal to read back what you thought and did, you'll have an honest record of what you actually knew at the time, not what you think you knew in hindsight. Okay, loss aversion is a big one and very much recognizable. It's that gut-wrenching feeling you get when you're losing money and the overwhelming urge to do whatever it takes to avoid more losses. Psychologists say we feel the pain of a loss about twice as intensively as the pleasure of an equivalent gain. So if you lose $100, it hurts way more than the joy you feel from making $100. And in trading, this can lead to some very bad habits. One common way a loss aversion shows up is when traders hold on to losing positions for too long in the hope it will bounce back. And instead of cutting their losses, they double down. And they probably think, I can't sell now, it's not a real loss until I close the trade. Another example is taking profits too early because you're scared the market might turn against you. And both of these behaviors come from the same place, fear of loss. Now, recognizing loss aversion starts with paying attention to your emotions during trades. Are you hesitating to sell a losing position because it feels too painful to lock in the loss? Or are you closing a winning trade too quickly to protect your gains? Then recognize that these are signs you're letting loss aversion drive your decisions. To fight this bias, you need to reframe how you think about losses. And instead of seeing them as failures, you think of them as part of the process. No strategy wins 100% of the time, and losses are just the cost of doing business. Setting predefined stop-loss levels and profit targets can also help. Once they're in place, stick to them. Don't let your emotions overrule your plan. And personally, I also had a tough time with loss aversion when I first started trading. I held on to losing positions way longer than I should have because I always thought that they would actually recover. And one time, I refused to sell a position in an altcoin that was 50% down, and eventually I ended up losing 90%. If I just followed my own stop-loss rule, I could have saved myself a lot of pain and money. But such is life, and now I remind myself regularly that taking a small loss is way better than letting it snowball into something catastrophic. Now, the sunk cost fallacy is somewhat related with the loss aversion bias. And this fallacy happens when you keep pouring resources like time, money or effort into something just because you already invested so much into it, even if it's no longer a good idea. In trading, this often happens when people hold onto losing positions because they feel emotionally attached to whatever they put in it. It's that voice in your head saying, I can't sell now because I already lost too much. And this bias is rooted into the idea that we hate wasting resources that we already have invested in something, like money, time or effort. That emotional attachment clouds our judgment and makes us more likely to double down on bad decisions. And the reality is that the market doesn't care how much you already have lost. It only cares about what's happening now and what's likely to happen next. Now, if you recognize the sunk cost fallacy, you should start with how you approach your trades. And if you're refusing to close your losing position because you think that you already lost so much and you cannot quit now, then you know that the sunk cost fallacy is talking. Now, to overcome this, you should reverse your thought process and need to think in terms of opportunity cost. And you should ask yourself, If I were starting fresh today, would I open this trade at this current price? If the answer is no, then it's time to let it go, no matter how much you already lost. And it also helps to have a plan in place, like very strict stop-loss levels, so you're not making decisions based on emotions in the heat of the moment. I also had a somewhat similar experience in the past, and I will never forget that lesson. A long time ago, I learned the phrase "kill your darlings" after I have put much effort into developing a project portfolio management process and nobody wanted to use it, because the organization I worked for just wasn't ready for it yet. But because I had put so much effort and energy into developing this system, I was kind of stuck and didn't want to abandon this project of mine. Then my team manager took me aside and said to me that sometimes it's better to kill your darlings and move on. And after I did this, I could energize myself again in another project and never thought about it again, until the moment I learned about the sunk cost fallacy. Now, this is another interesting bias. Herding bias is when you follow the crowd because, well, everybody else is doing it. In trading, it often looks like piling into a popular meme coin or market trend without doing your own analysis. It is that fear of missing out combined with the comfort of being part of the majority. But just because a lot of people are doing something, it doesn't mean it's the right move. Markets driven by herd behavior often lead to bubbles or crashes. And this bias happens because humans are social creatures. Following the crowd feels safe, especially in uncertain situations. And if everybody's buying a hot coin, you think, they can't be all wrong, right? But the reality is that herding can create artificial demand, driving prices higher than they should be, which sets the stage for a sharp correction. For example, recently with the Trump meme coin, everybody and their mother was talking about it, and artificial demand was created to let people fall into the herd behavior trap and let them invest money into a coin that was hyped up beyond belief. You can spot herding bias if you notice yourself making decisions based more on what others are doing than your own analysis. And if you're buying a coin just because it's trending on social media or because everybody is talking about it, you're probably in herd mode. Another sign is when you're ignoring your own usual trading rules or strategy to chase a trend. And the best way to avoid herding bias is to focus on your own research and stick to your strategy. Ask yourself, do the fundamentals of this coin or market trend align with my analysis? And if the answer is no, resist the urge to jump in, no matter how popular it seems. Sometimes the best trades are the ones you don't make. Now, self-attribution bias is when you take credit for your successes but blame external factors for your failure. In trading, this might look like patting yourself on the back after a winning trade, thinking that you're a genius, but then blaming the market, bad luck or something unexpected for a losing trade. And this is actually quite natural, but it prevents you from learning from your own mistakes. This bias stems from your need to protect your ego. Success feels great and we want to own this, but failure stings. So therefore we deflect responsibility to avoid feeling bad about ourselves. Now, the problem is that if you're not taking responsibility for your losses, you're missing opportunities to improve. And you can recognize self-attribution bias by looking at how you review your own trades. If you are only analyzing your losses to find external factors to blame, or are you brushing off bad trades as flukes without digging into what went wrong? Do you see your wins as proof of your brilliance without acknowledging any luck involved? If the answer to all these questions is yes, then you might suffer from self-attribution bias. Now, to combat this bias, you need to take an honest and objective look to all your trades, wins and losses alike, and you should ask yourself what decisions led to this outcome. Was it skill, luck, or a mix of both? And keeping a detailed trading journal can help with this. Here you should be honest and write down your decisions for entering and exiting the market. You should take a look in the mirror when you make this journal, and in the end it will help you tremendously. Okay, now the framing effect is a bias where the way information is presented influences your decisions, even when the underlying facts remain the same. In trading, this might mean reacting differently to the following statements. This trading strategy has a 70% success rate, compared to this strategy has a 30% failure rate. Both statements mean the same thing, but the way they're framed affects how you perceive them. And this bias happens because our brains are wired to respond to context and emotional cues. Positive framing makes us feel more confident, while negative framing triggers caution. And in trading, this can lead to poor decisions if you are swayed to how information is presented rather than the facts themselves. Also, recognizing the framing effect does require some critical thinking. When you encounter a piece of information, always ask yourself, is my reaction based on how this is worded or to the actual data? And awareness is the first step to breaking free from this trap. To avoid the framing effect, focus on the raw numbers and facts. Strip away the emotional language and look at the data objectively. Now, if someone tells you that a strategy has a 70% success rate, then you should remind yourself that it also has a 30% failure rate, and vice versa. You should also take other factors into consideration if you truly want to know the performance of an algorithm. What's the drawdown? What's the time frame? What's the period in which this backtest was done? And by forcing yourself to view the situation from multiple angles, you can make more balanced and informed decisions. Now, I remember a friend telling me about a high-risk trading strategy he found on YouTube. He was really excited about it because it was marketed as having a huge profit potential. But when we looked deeper, it also had a massive drawdown risk. The test was also done in a highly bullish period and did not mention the performance during the bad times. The positive framing almost blinded him to the potential downsides. And if we hadn't reframed the information, he might have jumped into a very risky trade without fully understanding the dangers. And by the way, this bias is actually one of those main reasons why I started to do my own extensive backtests and later decided to create this channel about it. The availability bias occurs when you rely too heavily on information that's readily available or recent, rather than seeking out a more comprehensive picture. And in trading, this might mean focusing on the latest news or market events while ignoring historical data or broader trends. It's like assuming the weather tomorrow will be the same as today because that's the easiest information to recall. This bias is caused by how our brains prioritize recent or vivid information. Things we just experienced or heard about feel more relevant, even if they are not the most important factors. And for traders, this can lead to overreacting to news events, ignoring long-term data, or making decisions based on incomplete information. You can spot availability bias when you notice yourself overemphasizing recent trades, news, or market trends. For example, are you buying a coin because it was just shilled in a YouTube video without digging deeper into its fundamentals? Another example might be that you're assuming that the recent market crash will continue indefinitely because it's fresh in your mind. And the best way to combat this bias is to take a step back and gather a broader range of data. You should look beyond the immediate headlines and recent trends. Historical data, multiple timeframes, and diverse resources of information can help you see the bigger picture. It's also helpful to have a systematic trading process that relies on objective criteria rather than gut reactions to the latest news. And this bias has made me make one of the biggest mistakes of all. I fell into this trap during the 2020 market crash because news about the pandemic dominated every headline, and I started to think that the market would never recover. So I sold off all the positions prematurely, only to watch the market bounce back shortly after. If I had taken a step back and looked at historical data on market recoveries, I might have avoided that costly mistake and would have more crypto in my portfolio than I have now. I consider this now as my tuition fee or learning costs. It was a lot of money, but in the end it's worth it. The disposition effect is when traders tend to sell winning positions too early while holding onto losing trades for way too long. It's like cashing in on your small wins quickly because they feel good, but refusing to let go of the losers because you're hoping they'll recover. And this behavior is rooted in your emotional reactions to gains and losses. This bias happens because of two conflicting emotions: the joy of locking in a win and the fear of admitting defeat. Selling a winner gives you immediate gratification, but selling a loser feels like accepting failure. So traders end up cutting their winners short and letting their losers run, which can sabotage overall profitability. Now, to recognize the disposition effect, pay attention to your trading patterns. Are you quick to sell when you're in the green, but hesitant to close losing trades? Do you often regret selling winners too early and holding on to losers that continue to decline? These behaviors can be clear signs of the disposition effect. And to combat this bias, you need to shift your mindset. You should remind yourself that the market doesn't care about your emotions, and it only cares about the numbers. One effective strategy is to set predefined exit rules for both gains and losses. For example, use stop-loss orders to limit your downside and take profit levels to lock in gains systematically, rather than being based on emotions. And yes, I too have been guilty of the disposition effect myself. I once held onto a poorly performing coin for months, convincing myself that it would recover, even as the fundamentals worsened. And in the meantime, I sold other coins that were doing well after just a small gain, fearing that the profit might disappear. Looking back, I realized I needed to trust my trading plan more and not let emotions dictate my decisions. And you might already guess by now why I'm so fond of algorithmic trading with the help of a trading bot. Another interesting bias is the gambler's fallacy. This is a bias where you mistakenly believe that past events can influence the likelihood of future outcomes, even when they're completely independent. In trading, the example looks like this. The market has been up for 5 days in a row, it has to come down tomorrow. Or I've had 3 losing trades in a row, the next one is bound to be a winner. And this is a dangerous mindset, because markets don't work on some cosmic balancing act. Each event is driven by its own unique circumstances. This bias happens because our brains are wired to look for patterns. It's an evolutionary survival skill that helped our ancestors, but in trading it can lead to flawed reasoning. We tend to believe that streaks, whether good or bad, are unsustainable and that a reversal is due. However, in reality, each trade or market move is influenced by current conditions, not by what happened before. You can spot the gambler's fallacy if you find yourself predicting outcomes based on previous streaks. For instance, are you betting on a reversal just because the market has been trending in one direction for a while? Or are you increasing your position size after a losing streak, thinking that you're due for a win? Now, these are clear signs of this bias at work. And to avoid this bias, remind yourself that each trade or market event is independent instead of focusing on streaks. You should base your decisions on data and analysis of the current market conditions. For this bias, it can also help to rely on systematic strategies that don't leave room for emotional or biased decision making. A well-tested algorithm or trading plan can act as a guardrail against this kind of thinking. One classic example of the gambler's fallacy involves rolling a 6-sided die. Imagine you have rolled the die 10 times and each time it has landed on the numbers 1 through 5 and never on 6. Now you might start to believe that the 6 is due because it hasn't appeared yet. And this is a perfect demonstration of the gambler's fallacy, because each roll of the dice is an independent event with a 1 to 6 probability for each number, regardless of previous outcomes. The belief that a 6 is more likely to appear after a series of non-6 rolls is a cognitive bias, not a mathematical truth. Remember this well. The endowment effect is when you overvalue something simply because you own it. And in trading, this often means holding onto a coin or asset for way too long because you developed an emotional attachment to it. It's like saying that the coin has been good to you in the past and it will come back again, even when all signs point to being time to let go. And this bias happens because ownership creates a sense of attachment. Once we own something, we see it as more valuable than it objectively is. In trading, this can lead to irrational decisions, such as refusing to sell a losing position or ignoring better opportunities because you're too focused on what you already have. And if your emotions are based more on emotional attachment other than data or strategy, then you're likely falling into this trap. Now, to overcome the endowment effect, practice detachment. Treat every trade as a business decision, not a personal one. You should regularly reassess your positions and ask yourself if you didn't already own that asset, if you wouldn't buy it today. And if the answer is no, then it's probably time to sell. Another helpful approach is to set predefined rules for exiting trades, so you don't get emotions dictate your actions. And there's also this famous saying, don't marry your coins. And I myself are prepared to sell everything once the bull market top gets in sight. No coin will be spared. So there you have it, an in-depth look of some of the more common psychological biases that can creep into your trading and mess with your decision making. From confirmation bias, where you only see what you want to see, to the sunk cost fallacy, where you hold on to losing trades for way too long, or to endowment, where you manage your investments. Now these mental traps can sabotage even the best laid plans if you're not careful. Now the good news is that by just being aware of these biases, you've already taken the first step toward overcoming them. Always remember that trading is as much about mastering your own psychology as it is mastering the markets. Stay disciplined, stick to your trading strategy, test it well, and always strive to make decisions based on data, not emotions. And if you do slip up now and then, well, then that's okay. It's all part of the learning process. Now, if you found this video helpful, then make sure to give it a thumbs up and don't forget to subscribe for more insights like this. Everything I explained here can also be read in my book about algorithmic trading for beginners. Thanks for sticking with me through this long and somewhat unusual video about trading psychology, and I'd also love to read your thoughts in the comments as well. Have you ever caught yourself falling into one of these biases, and how did you handle it? Let's keep the conversation going and help each other grow as traders. This is it for me in this video, and I will see you in the next one. Goodbye!